Trump just changed the rules of the global game. If you don't follow the money, you will be left behind. At first glance, this might sound like just another political statement in a world already drowning in headlines about Russia, Ukraine, China, energy, and inflation. But when you connect the dots around the September 13th announcements, a very different picture appears. A global asset redistribution mechanism is switching on, and those who understand it early and move with the capital flows will be the winners. Stay to the very end because I'll show you exactly how, whether you live in the U.S. or not, you can swim with the sharks, cut your risk, and capture the reward. On September 13th, 2025, President Trump called on all NATO countries to stop buying Russian oil, while also urging tariffs of 50% to 100% on Chinese imports. He emphasized that the U.S. is ready to impose major penalties on Russia if NATO moves together and allies cut Russian oil. The public rationale: exert maximum pressure to end the Russia-Ukraine war quickly to save lives and resources. Major outlets carried this the same day, according to Reuters, AP, the Los Angeles Times, Axios, CBS, and The Guardian. The message was clear: cut Russian oil plus heavy tariffs on China in the name of humanitarian urgency. End the war quickly. But what lies behind that humanitarian veneer? Picture a three-layer chessboard. Layer 1. Strip Russia's war financing by choking energy revenues, especially oil and LNG. Layer 2. Break China's leverage over Russia with punitive 50 to 100% tariffs, promising to lift them once the war ends, turning the tax stick into diplomatic leverage to force Beijing to adjust its economic backstop for Moscow. Layer 3. If Europe loses cheap Russian energy and must harden its defenses, who becomes the substitute supplier? American energy, American technology, American defense. And behind those sectors stand Wall Street and the U.S. dollar, as reported by Reuters. Why oil and LNG? Because even though the EU banned most Russian seaborne crude, loopholes remain, pipeline flows for some countries, and above all, LNG. In the first half of 2025, energy trackers noted the EU was still a major buyer of Russian LNG, with key entry points in France, Spain, Belgium, and parts of the Netherlands. Translation: cash still flows to Moscow via liquefied natural gas. And here's the twist: American LNG now commands the largest market share in EU LNG imports, surging since the war began. In other words, if the Russian valve is tightened further, the American valve opens wider, according to IEEFA and the Brussels Times. Of course, Russia doesn't sell only to Europe. China and India have become massive buyers of Russian energy since 2022. In July 2025 alone, analysis by ISRA indicates China spent roughly 6.2 to 7.3 billion euros, and India about 3.5 to 4.1 billion euros on Russian fossil fuels. With flows this large, if NATO/EU hit China with 50 to 100% tariffs, as Trump urges, Russia's wartime cash gets squeezed via its biggest buyer. Trump also said tariffs would be removed when the war ends, an economic condition for peace, as reported by Kyiv Post and others. So what's the real economic play? One arrow, many targets. Target 1. Replace Europe's energy supply. As the EU reduces Russian oil/gas, U.S. LNG and shale oil get a wider runway. The EU already ramped U.S. LNG to record levels after 2022. Close the Russian door harder and the American door swings open. Revenues rise, jobs expand. In drilling, shipping, LNG terminals, shipbuilding. That's a domestic industrial lever. See EU Council/Concilium briefings. Target 2. Rebalance technology. If tariffs or sanction risks make Chinese chips/software harder to buy, Europe turns to America. AI chips, cloud, cybersecurity, enterprise software. U.S. tech revenues embed deeper into Europe's digital infrastructure. Target 3. A defense boom. The moment security risks rise, like recent Russian drones probing Polish airspace, NATO budgets gain a lawful reason to surge. Who benefits? Lockheed Martin, Northrop Grumman, RTX, Raytheon, General Dynamics, long cycle contracts, multi-year deliveries, resilient margins. U.S. media have underlined how Trump's energy demands link with a harder NATO posture as risks escalate along Europe's eastern flank, as covered by the Los Angeles Times and others. Target 4. Pull global capital into America. Higher European energy costs thin industrial margins. Political security risk rises. Investors seek quality havens, USD, U.S. Treasuries, and American equities, especially energy, defense, and tech. Wall Street wins twice, from capital inflows and from U.S. corporate earnings uplift. Why did Trump frame it as humanitarian? Because ending a war is the most universally persuasive message. He says this is not America's war. He wants it ended fast to avoid waste and save lives, and that the combo, high tariffs on China plus cutting Russian oil, will snap the lever Beijing holds with Moscow. Wording varies by outlet, but the logic frame is consistent. Do this to end the war sooner, as echoed by ABC and other networks. But even a humanitarian policy can be a profit play. Follow the money. If NATO stops buying Russian oil, the EU must find a replacement. U.S. LNG infrastructure is ready, and America already holds the top share. If NATO/EU levy 50 to 100% tariffs on Chinese goods, European supply chains reroute toward U.S. technology, equipment, software, semiconductors, or to U.S.-aligned producers. And as Europe's risk rises, U.S. markets pull in more capital. All these targets point to the same destination through 4 pipelines: energy, technology, defense, and finance. EU Council/Concilium briefings highlight the policy plumbing. A critical question: will Europe easily unite? Not likely. Some countries still buy Russian energy via exemptions or LNG. Recent data show Hungary and Slovakia maintain special flows. Belgium, France, Spain function as Russian LNG hubs. That makes acting as one an EU political puzzle. Each country faces different energy interests and voter pressures. Precisely for that reason, if Trump raises the political cost of buying Russian energy through public pressure plus tariff threats, EU leaders will be pushed to accelerate the shift, and the replacement supplier is obvious. KREA and other trackers note these patterns. And what about China? If NATO-EU jointly impose 50 to 100% tariffs, Beijing will retaliate with counter-tariffs or non-tariff barriers, licenses, standards, inspections. Short-term, Europe faces higher prices and supply chain friction. Medium to long-term, EU firms diversify away from China, elevating India, Vietnam, and Mexico on the production map. Here, U.S. tech/design/IP holds the core position from chips to cloud, digging deeper roots into non-China manufacturing ecosystems. U.S. coverage, including the Los Angeles Times, has highlighted this migration logic. What are the risk scenarios? 1. Global energy prices can spike if Russian oil/gas are cut too fast without adequate alternatives, especially into Europe's winter. 2. Imported inflation in the EU rises, growth slows, the euro weakens. 3. Chinese retaliation raises costs for EU-US exports in return. 4. India, a major buyer of Russian oil, gets pulled into the storm if secondary tariffs emerge. U.S. networks like CBS News have discussed this India tax angle as a side lever on Russia's buyers. But for investors, risk not equal to no opportunity. The real question is, where will the money flow? History shows that when geopolitics lifts defense budgets, when energy security becomes priority number 1, and when tariffs barriers reroute supply chains, 3 asset clusters tend to get support. 1. Energy and energy logistics, LNG, midstream oil service ecosystems. 2. Defense and cybersecurity, multi-year government contracts, predictable cash flows. 3. Core technology, semis, AI/cloud infrastructure, security software. In parallel, prudent investors keep a shield, gold, silver, and cash-generative businesses with sensible leverage, especially mid-large caps directly lifted by defense and energy security spending. Guidance, not personal advice. Always respect your local rules and your risk tolerance. So what should Americans do? First, don't sit out. If you have a 401k or tax-advantaged account, check your exposure to energy defense technology. Most big index funds already hold these backbones. Your job is to go with the sharks, not against the current. Second, build an inflation shield, a slice of precious metals or steady dividend payers, utilities, pipelines, defense primes to smooth volatility. Third, if you're a technical worker, watch the LNG ecosystem, port ships cold storage, cybersecurity, AI. That's where budget flows surge if this strategy follows through. This tracks with the policy signals and the September 13th news cycle widely reported by Reuters and others. And if you're outside the U.S., the opportunity is far from small. One, you can access U.S. equities/ETFs via international brokers within your country's laws. Focus on themes over single names, energy, defense, cyber, AI chips. 2. Use gold/silver or broad commodity ETFs as macro shields. 3. Track the manufacturing migration out of China. India, Vietnam, Mexico are rising. Opportunities show up in industrial parks, logistics, ports, power, water infrastructure, or local stocks that win from FDI. 4. If your country sells into US-EU markets, ask where your exporters sit on the value chain. Tighter standards and less Chinese competition can lift margins. A brief reality check. There is no free lunch. If NATO/EU implements Trump's plan, short-term costs will rise. Energy and consumer goods get pricier. Small businesses feel the squeeze. But remember money's affinity. It flows to where returns are protected and paid. Defense contracts are long dated. Energy is a hard necessity. Core tech enjoys temporary monopolies. If you stand in the right stream, short-term inconvenience can become long-term gain. Back to the humanitarian frame. Ending the war is a goal everyone applauds. But in Trump's design, the way to get there is financial constriction, cut Russia's energy income, and slam high tariffs on China to break the leverage Beijing is seen to hold over Moscow. Major outlets have spelled out the core message: tariffs of 50 to 100% lifted when the war ends. A financial whistle in place of a military bugle. Behind it all, America positions itself as the indispensable supplier, energy, defense, technology, while Wall Street becomes the world's capital junction. AP and others have carried that framing. Do you see how elegant this is as a chess problem? 1 public move, 2 shadow moves, 3 profit zones converging on 1 center. And when money starts to move, the map of wealth gets redrawn. The only question that matters now is, where are you standing on that map? If this video is useful, don't blink, because I'm about to give you the 3-step play to swim with the sharks. The true follow the money approach. Step 1, track the policy levers. Watch updates on cutting Russian oil and the evolving tariff framework on China. These 2 levers will set the up-down rhythm in energy, defense, and technology. The September 13th cycle was a key trigger, widely reported by Reuters. Step 2, camp at the money's landing spots. Prioritize stocks, ETFs with long-dated cash flows from defense contracts, LNG infrastructure, and AI/cyber platforms. Pair them with shields like precious metals or steady dividend names to temper volatility. Step 3, discipline and defense. Define allocation bands and risk limits before you buy. Then adjust position sizes based on macro signals, LNG prices, defense budgets, sector ETF flows, so you scale with evidence, not emotion. Trump just changed the rules. Will you follow the money or get left behind? Subscribe to this channel. This is where ordinary people learn to change their lives and reach financial freedom by swimming with the sharks and using the predictable cycles of the global economy intelligently. This is Ascend Your Mind, revealing the secrets behind every political and economic move on the world stage and helping you build wealth fast and build it to last. I truly believe this message will spread and that many of you can build wealth and financial freedom by applying these insights wisely. It is my sincere wish that everyone who watches these videos reaches financial independence. That is the purpose behind every video I create. See you in the next video.